Welcome everyone to Japan Investing Summit 2012. This is John Mihaljevic. It's my pleasure to have everyone here on this conference with us. Today we have a real treat for our first presentation. It's our keynote session. I want to turn it over to Oliver to do the introduction, but before I do that, I want to let everyone know that this call is being recorded and will be available for replay in the online conference area. Also, you do have the ability to ask questions, so please take advantage of that. You can type in your questions at any time into the online interface. And with that, I want to turn it over to Oliver.
Thanks, John. It's a great honor and a pleasure to introduce Shuhei, the president and CEO of Sparx Group based in Tokyo. Abe-san is a true Japanese investing pioneer, having worked with George Soros in the 1980s before founding Sparx in 1989 to focus on bottom-up investing in Japanese equities with a particular focus on small caps. Since then, of course, Abe-san has built up Sparx from scratch into Asia's leading investment firm with more than $6 billion of assets under management across various asset classes and investment strategies. Some of the firsts for Sparx include introducing the equity long-short strategy to Japan and becoming the first publicly listed investment advisory company in Japan. More recently, Sparx has expanded from its stronghold in Japan into other Asian markets to become a center for intelligent investing across all of Asia. So we're very fortunate to have Abe-san's perspective here today to share some of the secrets of his success over the decades in a market where many investors have failed. And with that, Abe-san, please go ahead.
Thank you very much. Good afternoon, ladies and gentlemen. First, I would like to thank John and Oliver of valueconferences.com and the Manual of Ideas for giving me this opportunity to participate in Japan Investing Summit. Technology allows me to speak live from our Tokyo headquarters to a global audience, something not possible just a few short years ago. Today's speech is entitled, Why Japan? Lessons from the Past, Opportunities for the Future. Let me start by sharing a historical chart of Nikkei 225, beginning in 1989, the year I started Sparx. As you can see, the Japanese stock market currently is trading 80% lower than its bubble peak. Yet, Japan still is not out of the long-term downward trend. The first collapse began back in December 1989, when the Nikkei 225 was close to 40,000 yen. The market declined by 64% over 32 months. The second major decline was the bursting of the internet bubble in April 2000, and the market fell 64% from 20,000 yen over a period of 36 months. The most recent major fall began with the global financial turmoil that started in June 2007. The Japanese market fell 62% from 18,000 yen over 12 months. This recent fall was the fastest of the three major declines. Though it has been 5 years since the bursting of the U.S. housing bubble, the current Japanese stock market remains 53% lower than its most recent peak in June 2007. I believe that Japanese market has priced in the negative factors and the downward trend was run its course if you compare it to its technical trends over the past 25 years. For example, if you look at the price to book ratio, Japan is cheaper than the other major markets. And the price to earnings ratio has converged with those of other major markets. Through this presentation, I'll explain why we should view the Japanese market with optimism for the coming years. Global equity markets went through tough times, but the Japanese equity market declined more than most of major markets after the financial turmoil. It is too early to say if Japanese equities will go up structurally over the long term, but at least for the next 12 to 24 months, the Japanese equity market has a very good chance to outperform the global equity market, in my opinion. Today, we'll view the long-term trends of the Japanese economy and discuss my general outlook for Japan. Let's take a look at Japan's GDP growth after the bubble burst. Back in the 80s, Japan enjoyed strong GDP growth ranging from 4 to 8%. However, after the bubble burst, Japan entered an era of zero growth, where the GDP growth rate hovered between -2% and +1%. Let's explore some of the key reasons why Japan has stuck in an era of zero growth for over 2 decades. First of all, the 1989 bubble burst forced Japan to restructure and deal with a large amount of debt. As highlighted on the following slide, Japan held a large amount of land and equity investments on the left-hand side of its balance sheet. Japan's total land value declined from 2,500 trillion yen in 1990 to 1,200 trillion yen in 2010, a loss of 1,300 trillion yen. This loss is about 2.8 times bigger than Japan's annual GDP. The Tokyo Stock Exchange's total market capitalization declined from 600 trillion yen in 1990 to 250 trillion yen in 2012, a loss of 350 trillion yen. This loss in market cap represents about 70% of Japan's annual GDP. In other words, Japan had a total asset of 3,100 trillion yen at the bubble peak. However, Japan incurred paper loss of 1,600 trillion yen and significant related debt restructuring. This is the beginning of a long-term deleveraging process where firms could not invest in the economy, leading to significantly lower domestic demand. The size of this adjustment was staggering. To put the 1,000 trillion yen into perspective, it is about 20 trillion US dollars at today's exchange rate. That is about 10 times as much as the US federal government collects in tax revenues annually. Another reason why Japan is stuck in this zero growth is that Japan has been handicapped by the continuous appreciation of the yen. Following the devaluation of the US dollar in August 1971, Japan moved from a fixed exchange rate system to a floating exchange rate regime in February 1973. As a result, the yen appreciated against the dollar by 50% from 360 yen to 180 yen between 1971 and 78, respectively. Japan transformed its business model from exporting low value-added products like textiles, to export higher value-added autos and high-tech products to withstand strong yen. This transformation was a great success, which caused a currency problem. So the world decided to strengthen the yen, and the Plaza Accord was adopted in autumn of 1985 in order to address Japan's trade surplus. After the Plaza Accord, the yen surged 49% over 28 months, from 250 yen to 160 yen towards the end of 1987. And the economy entered into a high yen recession. After the Plaza Accord, the Bank of Japan aggressively eased its monetary policy to expand domestic demand. However, it ended up rising prices of assets, including real estate and equities, which created the bubble economy. And when the bubble became unsustainable, the Japanese bubble economy burst and asset price crashed. This is the beginning of Japanese deleveraging, deflation, and yen appreciation. In the late 1990s, the relative attractiveness of the yen to the US dollar declined, and the exchange rate of the yen remained boxed in the range of 100 yen to 120 yen on the back of easing monetary policy to deal with post-bubble aftermath. This relatively stable and weak yen helped manufacturers to revive and expand in overseas markets. Due to the global economic slowdown triggered by the Lehman shock in 2008, the US Fed began printing aggressively, while the Bank of Japan was not. Thus, global investors shifted liquidity to Japan as a safe haven, and the yen advanced to the post-war highs. Having said that, I believe the sluggish Japanese equity performance over the past 2 decades and the 53% equity market decline since 2007 is driven by the deflationary environment. This deflation is rooted in deleveraging and yen appreciation. I believe that it is not realistic to assume the yen will further strengthen. This thesis is based partly on the current purchasing power parity of the yen and the positive developments in the US, including productivity, benefits from the shale gas revolution. Let's take a look at the deleveraging situation of Japan, the United States, and Europe. I will highlight the debt to GDP ratio of government, financial institutions, non-financial corporations, and households. In Japan, non-financial corporations deleveraged by 30% between 1990 and 2011, reducing debt by 200 trillion yen. On the other hand, the government continued to provide liquidity. Together with an increase in social security costs, public debt increased by 3.8 times. Going forward, I project non-financial corporations, which are no longer deleveraging, will continue to increase earnings. I will address the positive historic trends of Japanese corporate earnings in a few minutes. For now, please note the growth in Japanese corporate earnings will increase government tax revenues and reduce public debt. I believe this will be one of the major drivers of Japan's revival. In the United States, all sectors increased leverage between 1990 and 2011. However, deleveraging of financial institutions proceeded dramatically after the Lehman crisis. I am not an expert on the US economy, but I am optimistic about the US prospects for the coming years. The housing problem is being addressed, and the shale gas revolution is in progress. The US, which is one of the biggest energy consuming countries, will produce extremely inexpensive energy independently, and the U.S. will have more control of energy prices. The U.S. will be the biggest beneficiary of this dramatic decline in energy prices, given that U.S. natural gas price is about half of Europe's and 1/4 of Japan's. Let's take a quick look at Europe in general, and Spain in particular. As you saw in the example of Japan in 1980s and 90s, today's decline in European real estate prices and the expansion of bank debt are the underlying problems of the European debt crisis. But the leverage of European individuals will prolong the problem. This was not the case for Japan, as the individual saving rates were high. It took 20 years in Japan and 5 years in the US to delever. I believe Europe will need at least 5 more years to deliver, and that growth will be limited during this period. Now, let's turn to Japan and take a closer look at evolution of Japanese non-financial corporations in the process of deleveraging. This slide shows you the debt to GDP ratio of non-financial sectors in Japan and the US. During the 1990s, Japan's debt was more than 2 times its GDP. At that time, the US debt to GDP ratio was around 120 to 140%. As a result of deleveraging by the private sector in Japan and increased leverage in the US, the debt to GDP ratio of Japan and the US corporates have converged. It is significant to note that Japan repaid 200 trillion yen of debt during the zero growth era. This contrasts with the US debt, which continued to grow. Once Japan's growth rate turned positive, Japan can intensify its investment activities with cash flows and available financing. Let's take a look at the deleveraging process of Japan's private sector. This slide shows the evolution of the equity ratio, which is defined as shareholders' equity to total assets. There is a gap between the equity ratio of the manufacturers and non-manufacturers. However, the equity ratio continues to improve after the collapse of the 1980s asset bubble. Over the past decades, Japanese companies prioritized strengthening their balance sheet rather than investing for growth. Today, the balance sheets of Japanese companies are strong enough to increase investments for growth. Please take a look at the slide 14, which shows you the recurring profit of Japanese corporations and the dollar-yen rate over time. Despite the continuing strengthening of the yen, recurring profits of Japanese companies today exceed those of bubble period. I will touch on this in general detail later, but Japanese companies transformed their business models in response to the higher yen. On the other hand, the equity market remains 18% below its bubble peak. This illustrates global investors' disconnect with Japan. As I explained, the asset bubble damage Japan had to overcome was extremely large. That required a total restructuring of the Japanese system. The repeated failure of structural recovery created excessive pessimism prevailing over Japanese markets. So today's market levels have deviated from reality. Which sector is driving the earnings growth of Japanese companies? This slide shows the recurring profit of manufacturers and non-manufacturers. Since the internet bubble in 2000, non-manufacturing industries have outperformed manufacturing industries. After the collapse of Lehman Brothers, this difference widened. I interpret the trend as a result of the change in the business models of Japanese companies. Some manufacturers, including appliance makers, which face rapid commoditization of their products, have been struggling with the strong yen and the rise of Asian rivals. The earnings of non-manufacturing companies, such as emerging technology companies, and the general trading houses, which have invested overseas in natural resource development, have risen relatively rapidly. In addition, over the past 10 years, domestic consumption patterns have shifted to service such as communications from products such as cars. This slide shows you the recurring profit margin of Japanese companies. As you can see, recent margins of non-manufacturing companies are above those of bubble period, and the recovery is led by the non-manufacturers. Taking a long-term look at the profitability of the non-manufacturing industries, I see margins have expanded from those of 60s, those of 1980s bubble, and those of the internet bubble. As I mentioned earlier, the improvement in profitability is attributed to general trading companies and technology businesses, which are domestic demand-driven industries. Let's turn our attention to Japan's current account balance. The line shows you the current account balance. The yellow bars show you the trade balance of goods, and green bars track income earned from services, dividends, and interest, which are the two key components of the current account balance. The positive trade balance was the major component of current account balance for many years. However, in 2011, it turned to be deficit, 31 years after the energy crisis of 1979. The deficit trigger in 2011 was the increase in imports of fossil fuels of 6 trillion yen following the Fukushima nuclear plant meltdown. Japan used fossil fuels in an effort to reduce reliance on nuclear power plants. In any case, Japan is finding it difficult to maintain historic surplus trade balances. On the other hand, Japan has expanded the income balance as an alternative to the trade balance. For many years, Japanese companies have been moving production overseas, and this has driven expansion of income and helped companies to cope with the strong yen. Going forward, I expect Japan's income balance will expand as a result of overseas investment, especially in Asia, which has new markets and rapidly growing demand. I see investment opportunities for Japanese companies to invest aggressively to expand in emerging new markets with competitive products and services. Let's take a look at the deleveraging of the Japanese banking sector. After the collapse of the bubble economy, about 100 trillion yen was spent on the disposal of non-performing loans. As a result, the Japanese banks that had to strengthen their balance sheets had limited risk capital to invest when compared with the Western banks. At a macro level, this deleveraging slowed investment and economic activity, but helped the Japanese banks address the bad debt problem. At present, the non-performing loans ratio, which has been as high as 9% in the past, has come down to 1%. Non-performing loans are no longer a problem for Japanese banks. Consequently, Japanese banks currently are in a favorable position to take risk aggressively compared to banks in the US and Europe. Private funds supported the disposal of non-performing loans by banks. It was very important that Japan's household sector was not leveraged. Slide 20 shows you the loan-to-deposit ratio of the banks and the financial assets of the household sector. Households' financial assets, which include cash and deposit, have continued to increase even after the collapse of the bubble economy. Savings institutions are investing these deposits in government bonds. As a result, the government has been leveraging by borrowing money from Japanese households. This cannot continue as demographics moves from net savers to net spenders. The Japanese government will need to find new sources of financing. The government leverage creates some anxiety in global markets. This may be one reason global investors are unwilling to invest beyond short-term trading purposes. Let's think for a moment about the implications of banks investing in a large part of household deposit in Japanese government bonds. The loan-to-deposit ratio continues to decrease over the past 2 decades. Individuals did not invest in risk capital. But in hindsight, with deflation and the strengthening yen, Japanese households are leading global portfolio managers. If Japan moves out of deflation, I anticipate Japanese households will look for higher risk-return ratio assets. Slide 21 indicates that Japanese companies borrowing from banks has been increasing in recent years. Total syndicated loans for listed companies by Japanese banks in January to June of this year indicate this trend will continue. This data implies that Japanese banks are becoming more aggressive in corporate lending. As I discussed earlier, Japanese companies have rooms for additional leverage based on strong equity ratio trends and improving recurring profit trends. New capital deployment is always led by industry, and banks are merely reacting. This change is important as industrial capital moves toward risky assets. Financial markets will follow. I would like to summarize our investment thesis for the Japanese market in the final slides. This thesis has 4 general pillars. Shift from deleveraging to direct investment by corporations. Growth of consumption in emerging countries. Leveraging for new growth. Structural change to a greener society. After strengthening their balance sheet by deleveraging, Japanese companies are entering into a phase where they are investing aggressively. General trading houses such as Mitsui, Itochu, and Marubeni are an example. I want to introduce Mitsubishi Corporation as a brief case study. Mitsubishi diversified their business by deleveraging during the bubble period. However, after the bubble burst, they had to deleverage and dispose of unprofitable businesses. After that, Mitsubishi changed its business model to be an investment company, which springboards on its expertise and contacts. They have invested aggressively in resource interests, expanding both vertically and horizontally. As a result, profits are significantly improved and coupled with growth in Asia. I believe this movement will spread to the other industries. There are many Japanese companies with platforms and financial resources to replicate this success. There are some domestically oriented businesses that have successfully transformed themselves to global companies. Let's take a look at Unicharm, which manufactures hygienic products, baby diapers, and pet care products. Unicharm held leading domestic market share and built a strong brand in Japan through late 1990s. And through late 1990s, via high quality, well-regarded products. By the year 2000, Unicharm responded to the maturation of the Japanese market and entered the overseas market, principally in Asia. In these external markets, Unicharm grows revenues by leveraging high-tech, high-quality products and advanced production management. The Unicharm brand is succeeding in Asia, and its global market share in hygienic products and diapers have grown to number 3. For investors looking to find Japanese companies with good growth prospects, I believe it is important to find companies that have strong brands and dominant market share in Japan, and also market high quality products. Then investors must determine if these firms are willing and able to expand in global markets, mainly in Asia. While many companies have continued deleveraging, SoftBank has been aggressively growing. Although SoftBank's acquisition strategy appears reckless on first view, the company has been successful in accelerating their earnings growth by focusing on high growth markets. SoftBank has transformed its core business to become a communication infrastructure operator by investing to Yahoo in 1996 to replicate Yahoo in Japan, and acquiring Vodafone Japan in 2006. Recently, SoftBank announced the acquisition of Japan-based e-Access and acquisition of a 70% stake in US-based Sprint Nextel. It is too early to say whether this acquisition of Sprint Nextel will be successful, but it is noteworthy that the company's management has an entrepreneurial spirit, which is difficult to find in Japan, in my opinion. While some companies are pursuing organic growth, others are taking a proactive stance using such measures as M&A to help drive faster growth. As illustrated by SoftBank, Japanese companies have become active in overseas acquisitions on the back of the stronger yen. The historically strong yen enables, and in some ways encourages, Japanese companies to acquire significant assets overseas. This M&A trend will expand among Japanese companies as they come to terms with limited domestic market growth. I believe that a potentially huge market will be created by the structural changes happening today in Japan. It is an investment towards the energy industry, the renewable energy space in particular, and includes building a smart grid infrastructure. Until now, the electric power companies dominated Japan's power businesses, upstream to downstream, which were supported by the government over the past 5 decades. After the Great East Japan earthquake in 2011 and Fukushima nuclear plant meltdown, people in Japan are seeking to reform the electric power industry. With the introduction of the feed-in tariff in July 2012, investments in renewable energy plants are starting to make economic sense. A new market has been created and is generating stable cash flow. The chart on slide 28 shows you 3 options of the energy mix for the fiscal year 2030 being considered by the government. I want to emphasize that in each scenario, renewable energy will expand to at least 25 to 30% by the end of 2030, depending on the option the Japanese people choose. Renewable energy, including hydropower, was about 11% in 2010, as you can see in the green highlighted parts. If you take a closer look at the breakdown of renewable energy, solar and wind power are expected to expand significantly. If Japan tries to achieve the minimum 25% goal with only solar power and wind power, the total investment needed will be 56 trillion yen and 29 trillion yen. This implies that new capital deployment ranging from 1.7 trillion yen to 3.3 trillion yen per year could be created over 17 years until 2030. The chart on slide 29 is the conceptual diagram I put together, which shows you the implication of becoming smart grid society. In my opinion, the energy industry will go through a dynamic transformation from a large-scale fossil fuel-based one-way system to a small-scale diverse power system. With the development of a diverse power system, peripheral industries, including the storage battery industry and the plug-in station industry, will grow significantly. In addition to investments in listed companies, which have promising technology related to the environment, infrastructure, including mega solar and wind farms, could be another attractive investment opportunity. In closing, as I discussed, the Japanese equity market is at a major turning point after the end of a long-term process of bubble burst recovery. First, while bubble burst recovery in the Western world is in relatively early stages, particularly in Europe, the process will not be a short one. Japanese companies and banks are currently in a good position to accelerate growth by leveraging. It is amazing that the Japanese system was able to recover from such a massive bubble. But as I have highlighted, the Japanese system has one of the healthiest positions relative to the rest of the world. Second, the era of the strong yen is ending. The strong Japanese yen weighted on Japan's economy for many years since the Plaza Accord. Particularly after the Lehman crisis, the yen appreciation became excessive, which I believe is not sustainable. The reasons behind this are twofold. One, the US economy after 5 years is finally stabilizing. And shale gas revolution will create enormous productivity gains. Two, the Japanese central banks has finally begun to address the issue of deflation. I see the central bank easing to next year, even after a new central banker is appointed. It is too early to say that Japanese stock market will rise structurally going forward. However, at least for the next 12 to 24 months, I believe the Japanese stock market will achieve superior performance against the other major markets due to the reasons just discussed. And the market is trading 80% lower than its 1989 bubble peak, despite the fact that the current earnings exceed those of the bubble. In this environment, I see attractive investment opportunities in Japan. In particular, these include investing in companies which have room for financial leverage, which are expanding overseas with growth brands, and which have entrepreneurial spirit seeking growth. In addition, you should research how Japan's energy policy is shifting after the Fukushima nuclear meltdown. I am also very focused on companies with the technology and know-how to achieve a clean energy society. Thank you very much.
Thank you very much, Abe-san, for that insightful presentation. We already have a number of questions that have come in. I want to also remind everyone, if you do wish to ask a question, you can type it into the online interface right now and at any time during this Q&A. Perhaps, Oliver, I will let you ask the first question and then we'll go to the other questions. So, Oliver, if you'd like, go ahead with one question, please.
Thanks, John. Abe-san, I'm wondering, you didn't mention the small cap area at all. I'm curious how you see investing in small caps and the changes there over the last 2 decades. If you could contrast the opportunity in Japanese small cap stocks today versus when you started Sparx.
Well, I started the company in 1989, first as a specialist in small cap market in Japan. So we observed the trend of small cap relative to the overall market. There are cycles, clear cycles existing in small cap. The behavior of small cap, particularly in this whole trend of deflation in Japan, it's quite dramatic. When it declines, it always declines much more than the general market. And when it starts neutralizing the risk premium that they have to assume, the upside return is quite strong. The last cycle ended about 5 years ago. That was probably the end of 2006. And small cap market reflecting the risk that we had over the past 5 years, where Japan entering into the last but very strong phase of deflation and stronger yen. The market really collapsed. Our analysts and portfolio managers of Sparx sometimes say that companies trading at the half of the book value is still not cheap, telling me that it can be 0.3 times. So mentality of portfolio managers and analysts are excessively bearish. So I am now turning into the area where I see lots of very, very undervalued situations. When and how those situations will be corrected, it is very difficult to say. But as I said in my presentation, I think we are at the verge of quite dramatic changes. And the first catalyst that can create some optimism for the global investors will be the changes of currency situation. Yen start getting weakening. There is no reason that global capital continue buying yen against the other major currencies. Looking at the situation in the global trend now. So when that trend starts to be confirmed, people start looking into the opportunities and first adjust this undervalued situations, which is getting excessive to normal. Then we should look for the real growth situations among those companies which are still cheap.
Abe-san, on that point of currency, we have a question that's come in just now from Graham Cunningham in Switzerland. And he says, I agree that the Japanese yen will weaken due to many structural issues, aging, and the JGB overhang. Does this mean that, in your opinion, any equity investment should be hedged?
Well, as I said, I'm positive on the U.S. I think U.S. System addressed the problems that, in a way, we experienced 2 decades ago and suffered for 20 years. They addressed it very quickly and reacted to it very quickly. I see the bottoming out of those core problems that they have, that is housing problems and so forth. And at the same time, I see the area that will generate higher productivity and new cash flow, that is the energy area. This shale gas revolution is the real revolution that will change the U.S. industrial system. So I am quite positive, and I think starting from toward the end of this year through next year, people start appreciating it. And they found that current level of the yen is too excessive. But at the same time, we should also understand the potential growth rate of U.S. will not go back to where it was. It will be significantly lowered. So responding to the potential growth of the GDP of the U.S. system as a whole, I do not believe that the dollar will react that much. Yet, you know, when the trend happens, yen can be 90 to 100 range. It's basically what I see for the coming couple of years. So if the investor need to hedge that 10 to 20%, yes, they can. But for us, in basically investing in the yen terms, I'm not looking at that market too closely.
I think Oliver has a follow-up question. Oliver, go ahead.
Abe-san, I'm just curious on the small cap comments of yours. For our audience who may not be familiar with Sparx, it's a publicly listed group, and I've looked up the share price, and it does trade at a small premium to book. I'm curious if you could share with us some comments around how you would assess your own business here, and in thinking about intrinsic value, if you could share with our audience how do you see Sparx going forward?
Well, as I said, I started the company in 1989 and became public in the very end of 2001. On our IPO, during the IPO period, we had about $2.8 billion AUM. And our IPO market cap, initial price that market quoted, was about $170 million US. Today we have $6.2 to $6.3 billion AUM. And our market cap is about $130 to $140 million. So asset is twice bigger, but market cap is still lower than its IPO level. And at the peak, market priced our company a little more than $3 billion. When the optimism came, I think market appreciated our business model, that is alternative investment company pricing for investment management, and expecting that market trend that at that time people thought that continuous bullish trend, I will create the leverage gearing of earnings growth. But as soon as that boom ended, the reverse gear started damaging our business model as well as our market cap. I do not believe that we can repeat the exact same business model that we enjoyed during the first 10 years of our company started. But now we are a bit diversifying into our business scope because I see the investment opportunities as being located in Japan as well as in Asia. First, you have lots of new growth opportunities in Asian markets. Since global capital contracts, the first reaction is to sell everything. But if you look at the globe objectively, there are not too many places that you can see the real growth that is supported by in units. And we see lots of opportunities in these different Asian markets. Second, Japan still is the second largest economy in the world and creates very high quality cash flows related to certain asset class. And we as an investment company identify those cash flow and try to deliver that cash flow to the global investors. If you buy Japanese government bond, what you get for the coming 20 years is 1% cash on cash. But there are situations or cases that you can enjoy close to 10% without taking too much risk. And we are trying to invest in those asset classes and not really diversifying our portfolio, but we see those investment opportunities because lots of global investors are not really focusing on Japan. But I'd like to address the fact that quality of cash flow that Japanese system generates, if you look at the past 20 years, and as I showed in the earnings trend of Japanese companies, is still quite high and very high quality. So asset that can generate those high quality cash flow is the area that we should look into. And same principle will be applied when we research the companies. Companies who can generate cash in the long-term future. We will be very interested, and we believe that many more companies are getting into that trend.
Our next question comes from James East of Mercertus Capital in Charlotte, North Carolina, in the USA. And he is asking, saying some companies in Japan look extremely cheap on a Graham and Dodd approach, but much of the equity is sometimes in passive equity interests that never get sold. So how would you analyze and value such situations?
That's very true. One of the reasons that the world cannot react to the situation where you can buy very cheap companies in this country, that no one really believes that ownership transfer takes place. In U.S. market or other part of the world, if company gets too cheap, there are buyers and who will buy it and realize the value of it. But in Japan, unfortunately or fortunately for the management people, those aggressive measures were never employed. But I see even that trend will eventually changing. Particularly when I see the Asian conglomerates getting bigger in size, and they see huge market in front of them, and they see the highest quality product produced by Japanese companies, which value is absolutely cheap. So capital start looking into the opportunity to own or to manage those companies, to help the growth of those so that they can improve the value of the companies. So I think wherever it is, capital is capital. Capital is looking for a safe and long-term stable appreciation and returns. And Japan now offers many opportunities for those who have strategic mind and strategically trying to deploy their capital. So I'm hopeful that that kind of movement will start, and also Japanese will favorably react to those actions.
We have a question from Geert Kampert in Antwerp, Belgium. He would like to know whether you could comment on which Japanese companies you consider to have a wide competitive moat and why.
Wide competitive moat. What do you mean by wide competitive moat?
So essentially, which companies in Japan do you believe are very well positioned competitively on a global scale, and why?
Well, I cannot address too many individual company case, but company like Unitron, they have very strong brand built over the years in this market. And I'm sure the product quality, by far, is one of the best in the world. But unlike some of the US and European competitors, they never look into the opportunities emerging in the rest of the world until the beginning of 2000. But as soon as they entered and introduced the way that they conduct the business in Japan, in Asian countries, very interestingly, the method, managerial method that they introduced to Asian countries were very well received, and they could replicate the success that they built in Japan. If you look at the earnings, already half of their income comes from Asian markets. And I see many similar companies which have a similar competitive edge. I see the similar competitive edge among food-related companies, because as Asian middle class grows, what they care about their child. Mother thinks that they like to give a safe, high-quality food to the children. And I think they trust better Japanese products than their own products sometimes. So food area is very interesting. Unfortunately, there are not too many companies which makes food-related products or baby food-related products. Never looked into the opportunities emerging in the rest of the world, particularly in Asia. So first analyze the products and the quality of the production and brand and market share in this country, and base profitability of the business. Then we should analyze how that brand and core business can be transferred to the growing markets, particularly in Asia. So, like Warren Buffett says, analyze brand and to examine whether that can be replicated in the other part of the world. We should look, we can find lots of very, very deep value situations. Like Warren Buffett found Coca-Cola when he invested. Coca-Cola was not that cheap, but he found that brand quality and market monopoly that Coca-Cola had at that time creates further value. And very similar situations can be found in this market.
Now we have a question from Pablo Gonzalez of Abaco Capital in Spain. He is wondering if you could comment on the method you use to arrive at intrinsic value for equities, and are the parameters that you use different depending on the sector you are looking at?
Well, as you all know, simple PE number doesn't mean much. You cannot say PE of 5 is cheaper than PE of 8 sometimes, so we do not have a reference number when we analyze the earnings and also even the book value. But we are certainly looking into those universal valuation numbers. First, look at what the company has as a typical value investors, and at the same time, what will be the catalyst for the value will be appreciated by the participants, investors, and by the market. Is the management or the market of which they are in or the strategy of the management that to be employed. So those three components, that is business model, market they're in, and also the strategies, the quality of management. Three factors are very closely examined when we do the valuations. So whether it's cheap or not cheap is the first. And when we measure whether it's cheap or not, we can use different valuation methods, which is anything new. And second, I would always ask why it is cheap. And the third, how this undervaluation will be corrected. What should happen for the price to go up to the level of intrinsic value that you define or analysts define. So process is very simple, but to continue doing it, I think it's our asset. We've been doing this for over 24 years to cover entire Japanese universe. And now we're expanding the same method to Korea and the rest of Asia.
Well, it looks like we are almost out of time. So I'll ask one more question, and then I want to encourage everyone whose questions we could not get to please go online to our conference area. You'll have an opportunity to submit your questions there, and we'll still try to get those answered for you. Right now, to wrap it up, there's a question from Martin Conder of Novum Capital in London, the United Kingdom. He's asking, in a declining market environment, how did you retain the courage and confidence to carry on with your investment business?
Good question. Well, I sometimes think that being an entrepreneur is like being an artist or anything that you devote yourself. And I think this is it. This is the only thing that I can do, and I can create some value for the world. So it's been very hard, you know. Market never treated us kindly over the past 24 years. But this challenge made us more enthusiastic, you know, to really find the value. And I think Japan needed this time. If you think about how large and significant the bubble that we have to deal with. And as I explained, now the process is over. That value now will be appreciated by domestic capital as well as the capital overseas. Because if you look at the balance sheet of, in aggregate, of Japanese companies, it is the healthiest in the world. And as an observer of this problem over the past 20 years, I think other parts of the world should take a little more time to settle the problem. Problem is exactly the same that Japan had to deal with. And amount of capital that you need to settle it is not that small. But in our system, I think we generally finished that process. So now company can be aggressive to look for new growth under the totally new environment, where they can apply their expertise and quality to realize the value that they have.
Well, on that note, Abe-san, thank you very much for taking the time and for sharing your insights with our audience. I want to thank all of you for joining us from around the world today, and we look forward to engaging with you in our next session, which will be coming up in just about 25 minutes. Thank you all very much, and have a great day.